All right, well, welcome everybody. It is Wednesday, the 1st of May, if you can believe it. Can't believe we're in the 5th month of 2024 already. Feels like we should still be in January. But anyway, let's get this session started looking at sentiment and what we need to know as we get the session underway. Now, a couple of things to keep in mind. Let's start with last night, because even though we had a bit of a risk-off mood last night going into the close of the European session, that negative risk-off tone, it kind of accelerated throughout the session. I mean, we can see that equity futures are still quite pressured in the session. And if you take a look at the charts, I mean, we had quite a big deceleration in those moves from last night. Now, what was the trigger? There's a few catalysts in the mix that we need to talk about, as well as some interesting price action. Firstly, we already knew that knew about the upside surprise we had in the employment cost index for the US yesterday. That gave the markets that first bit of negative news, right? Where equity started to push lower. We had a little bit of a move to the upside in the US dollar. Nothing too major, but we saw that first initial pop up. We had precious metals pushing lower, equities pushing lower, and obviously yields going higher in that hawkish reaction to that employment cost index. Then after market, the market started to recover a little bit, or started to look a little bit more composed. And then suddenly going into the close, we just had that big acceleration in risk off again. Now, there's a couple of things to keep in mind. We obviously had earnings after the close. Now, the likes of Amazon and AMD, look, Amazon was up, close to 2% after earnings. It just wasn't enough to lift the mood with their earnings results. And obviously we saw that continuation in equities pushing lower. Now, what for me was very interesting though, was that despite the employment cost index data coming in higher, we did see the dollar and equities trade counterintuitively to the other data that we had yesterday, because it wasn't just the employment cost index. We had some other data, which, is quite interesting when you assess the price action in line with these additional data points. We had two things coming out, which was very negative. I mean, the Chicago PMI, as well as consumer confidence. Now, if you take a look at, let's put this on the chart just to put this into context. If you take a look at consumer confidence first, I mean, a huge deceleration, printing at 97. That's the lowest going back to July 2022. What we would have normally anticipated to see on the back of, well, before we get to the normal reaction, let's take a look at the data. So pretty big deceleration in consumer confidence. The other one was the Chicago PMI. Now, we need to always take the Chicago PMI with a big pinch of salt, because it is a noisy data point, to be fair. But I mean, that was the lowest drop, or the fastest deceleration, if you will, going back to November 2022. And this just feeds into other negative data that we've had in the last, let's just call it 5, 6, 7 trading sessions. Remember, we had that downside surprise in the S&P Global Flash PMIs for the US as well. We had the downside surprise in GDP for Q1, surprising to the downside with a drop of 1.6% for real GDP, which was quite a deceleration from the above 3% prior print, right? We even had the NFIB with their hiring plans printing a pretty negative number here. Apart from outside that huge drop we had with COVID, this would have been the lowest or the slowest growth in hiring plans for small businesses going back to October 2016. So we have all of these data points pointing to weakness. Now, with previous numbers looking so bleak, as well as yesterday's soft data looking so weak, I was quite surprised to see equities so much lower and the dollar so much higher, because in recent months, we haven't seen equities and the dollar trade that way to bad data, right? In recent months, equities have been trading with bad news as good news, meaning that good data has seen equity downside, while bad data, like we had yesterday, has seen upside. But we didn't see that yesterday, right? It's like the market was only focused on that employment data, which is interesting. The dollar as well, the dollar has been trading more cyclical when it comes to US data, meaning that good news has been good and bad data has been bad, but not yesterday. We had the dollar basically pushing up aggressively on higher employment data, but it ignored consumer confidence, it ignored Chicago PMI, and you would think that with all of the other data points missing recently, GDP, the S&P data, the NFIB, consumer confidence, and now Chicago PMI, you would think that should lead to more downside for the dollar, but we didn't see that. Now, when you think about the dollar smile theory, the move in the dollar is even more interesting, because other jurisdictions like the EU yesterday saw upside in growth data, even upside in inflation. while the US has been moving in more the opposite direction. Now, that is normally more dollar negative when you consider the dollar smile theory, because you're moving away from that US exceptionalism. Unless the markets are now starting to fear a US recession, which I don't think is the case at all. So, that makes the dollar strength very interesting. Now, some of the strength in the dollar yesterday could have been down to just plain old-fashioned month-end flows, and I do think that explains some of the upside that we had. But if it was all month-end flows, the move should have ceased yesterday after the 4 p.m. London fix, and it didn't. It accelerated to the upside. Now, there is a much simpler alternative, in my opinion, that explains the moves across the board in the simplest way, and that is that after the employment index data, the markets might just be now pre-positioning a lot more aggressively for a more hawkish Fed than previously anticipated. That would make sense, because if the markets was pre-positioning for a much more hawkish Fed, you would expect the dollar up, we're getting that. You would expect precious metals down, we got that. You would expect equities down, we got that. You would expect yields up, and we got that. So I think the price action we are seeing looks just like pre-positioning heading into tonight's Fed, where the markets are now preparing for a much more hawkish Fed. But what, in my opinion, what makes the pre-positioning argument surprising is that we still have to go through the ISM manufacturing. We still have to go through JOLTS. And you would think that the markets would want to wait for that before they pre-position. You would think that the recent data that we had would be enough reason for the Fed to be more cautious instead of a more hawkish tone. So anyway, I'm not fighting the markets on this move at all. It's just interesting to see this type of pre-positioning after the recent data, because it looks like the markets they just focus on that employment cost index number, and they're ignoring all the other things, almost like, ignoring, missing the forest for the trees type of thing, I think. But anyway, like I said, I'm not fighting the markets on this. It's just interesting price action. And again, when you consider how the dollar, how equities, how precious metals have traded in recent months, the only thing that makes sense of this price action is hawkish pre-positioning going into the Fed. Now, that in itself can create some good opportunities for us, but we will discuss that in more detail with our preview for the FMC a little bit later. So, with all of that said, that sets the mood, the context for where we are right now. So, what is sentiment looking like right now? Let's start with equities. Like we mentioned, we pushed lower quite aggressive yesterday. And even though we are seeing a little bit of a recovery earlier, we're basically still at yesterday's lows, especially looking at the likes of the DAX. That's now accelerating. The NASDAQ looks like we might have printed a new low as well. So equity still pressured here across the board. Commodities had a big move lower yesterday. We are seeing precious metals and base metals trying to put in a little bit, a marginal pop to the upside. The bottom line is commodities still pressured across the board. So equity showing us risk off, commodities showing us risk off. Even the bond market right now is showing us risk off as well. The reason for that, remember, in an inflationary cycle, or a cycle where inflation is the main focus for bonds, you don't expect it to trade like a safe haven like you would in a normal environment. Right? In a normal environment, you would expect upside in yields to be risk on, not risk off. But in this environment, bonds are selling off or correlated to equities because of the inflation angst. So yields up, bonds down. I know it's counterintuitive, but that is also pointing to risk off in a session like today. What about the FX space? FX is more interesting because in FX, we actually have the Aussie leading the pack to the upside and the Swiss franc leading to the downside. So that is pointing to slightly more risk on for the FX space, but in a session like today, going into key events, we always need to, read the price action with a pinch of salt. We would expect more choppy, more muted price action going into those key events. So just take what we see right now with a pinch of salt. It's basically just FX that's not trading in line with that risk of mood right now, which is just something that we need to be a little bit more cautious of. So we've got a busy day ahead. Full previews coming up for the ISM, the JOLTS. I'll do those two together. And then obviously the FMC a little bit later. As always, any questions, don't hesitate to let me know.